This is a special video. I have my special LA candlestick hat because we're really about to get into it. If I had to start over and learn technical analysis from scratch in 2025, honestly, knowing what I know now, I would do everything differently. That's why in this video, I want to share a game plan that I wish I had from day one. This is around the time where we're doing our 30-day technical analysis series on TikTok, so make sure you check that out. Now, trust me, this is not another technical analysis crash course or a checklist of fancy terms, but I promise you, this is going to be laser focused on things that actually matter to me. Okay, so let's go ahead and let's get into it. First, I just want to talk about why candlesticks matter. If you have a difficulty reading candlestick charts, then you're always going to be guessing in your trades. And in trading, guessing isn't just risky, but it's expensive. Candlesticks are like the market's language. So each one of these candlesticks is filled with hidden signals, and the body-to-wick ratio is going to be the key to unlocking what the market is actually telling you. Let me put it to you this way. If one candlestick is a letter, then a group of candles forms words. And those words come together to make sentences that spell out what the market is feeling. So that's whether or not it's confident, indecisive, or just outright rejecting the movement at that time. Now, I told you, this is not going to be another Candlestick Anatomy 101. Okay, we're getting into what actually matters. So by the end of this section, you'll not only know how to read candlesticks, but you'll understand why they're behaving the way that they do, so that you can start to apply that insight directly into your trading strategy. Stick with me on this, all right? Let's go ahead and let's get into it. I want to focus on what actually matters. You have to start with the candlestick energy. Let's talk about what's really happening inside of these candlesticks. Every candlestick consists of two important parts. Okay, so two really important things make up these candlesticks. You have the body. So the body, this is the heart of the candle. It's going to tell you where the market opened and closed. So if you see longer body, that screams momentum, and smaller bodies whisper that nobody's fully in control here. So if it's green, that means in that particular price movement, buyers were dominating the market. If it's red, that means for that particular time period, sellers had the upper hand. And of course, we all know that each one of these candlesticks, it's the amount of price data that's in there. It's going to be based on the chart time frame that you're looking at. So 1 hour chart, 1 hour worth of price movement. 4 hour chart, 4 hours worth. A daily chart, a day. So, okay, you know that. Now, the wicks. This is going to be where the drama happens. Wicks are very important with the candlesticks. If you see a long upper wick, that basically tells you that buyers were fighting hard, but the sellers eventually shut them down before the market closed for that period. If you see a long lower wick, that means that sellers were pushing aggressively, but buyers stepped in and took over in that round. This is where the magic happens. Look at the body to wick ratio. Now, this is going to be the signal that you don't want to ignore. So I'm going to break this down into 3 different scenarios so that you can kind of have an understanding of the psychology behind each one of these candlesticks. Now, you have dominance. This is where you're going to see those long bodies with short wicks. So what does it mean? If you see a candlestick that has a long body and short wicks, remember, we said this screams momentum. So right here, this is going to be a sign of dominance, whether or not it's buyers in an uptrend, bullish, or if it's sellers in a downtrend, bearish. Here's an example, the seller's opposition. Think of it happening after a breakout of a consolidation zone. That's not just momentum, but it's conviction. This is how you could use these candles in trading. Now, the second type of candle, which is pointing towards indecision. So when you have indecision in the market, the candlestick that you're going to see is going to have a small body, and it's going to have long upper and lower wicks. What does that mean? When you see a small body with long wicks on both sides, then that shows indecision. Buyers and sellers, they both pushed pretty hard, but neither one of them could fully take control. Here's an example. You might see this show up during a retest of a support or resistance level. So the market around this area, the market is struggling to decide which way is it gonna go. So how could you use these indecisive in your trades? So if you see this type of indecisive candle after a strong trend, then that may start to signal a potential reversal. Momentum is starting to get weak. For example, you see a lot of different candles with these long upper and lower wicks with small bodies. So you see a few different candles that are pointing towards indecision in the market. And you're seeing that around resistance zones. So this could be hinting that the bullish momentum is kind of starting to fade out. In this situation, you want to look for confirmation from volume and other indicators for a potential reversal. And the last type of candle I want to talk about is the rejection. All right. So this type of candle is where you're going to see long wicks. With rejection, you're going to see one long wick and a small body. So if you see candles that have one long wick and a small body, then this shows complete rejection from a critical level. So whether or not that's buyers or sellers, somebody took control there. So for example, if you see a candle that has a long upper wick and a small red body at a resistance zone, then this is showing that buyers tried to break out here, but they were rejected by the sellers. So you may potentially see that price start to move back down. Now, at the same time, think about a support level. Let's say you see a candle that has a long lower wick and a small green body. Then this type of candle is saying that the buyer stepped in to defend the price around this time. How can you use these rejection candles in your trades? You want to use these candles with key levels, whether that's a trend line, a Fibonacci level, a pivot level, or support and resistance. That's where these rejection candles are going to kill it. So for example, let's say you see a rejection candle near the 61.8% retracement level in a downtrend. If you see that, then that could be an early signal that could signal strong seller momentum. Now, I want to talk a little bit more about how these candlesticks start to tell stories inside of the market's structure. Think about engulfing candles. This is where we're seeing a momentum shift. If you see engulfing candlestick patterns, then that means that there's a dramatic shift in the market sentiment. So if you have a bullish engulfing pattern where you're going to see a large green candle that completely swallows a red candle that was before that, that screams buyer dominance. And so just imagine seeing bullish engulfing candles around trend lines. This could be a signal that the trend is going to continue. Next, think about hammer candles. These are going to be the strongest at the bottom of a trend. So a hammer shows that buyers were stronger here. Sellers tried to move the prices lower, but buyers stepped in and reversed that move. So that long lower wick and that small body screams that sellers are exhausted here. Now, think about a scenario in trading. After Bitcoin dropped to 17K, seeing hammer candles there at major support zones showed that buyers were starting to step in, and that hinted at a potential bullish reversal. Next are shooting stars. A shooting star highlights that buyers failed at higher levels. So sellers were more aggressive. They entered and rejected the price. So you want to look for those long upper wicks and small red bodies to get an idea of this. So just an example, you can use these with different indicators like the RSI indicator or the MACD for strong confirmation of a reversal. Now, how can you apply all of this information to your trading? What I've realized, instead of just memorizing these actual patterns, start to ask yourself a few questions. Why did this candle form here? Why are buyers or sellers showing indecision here? Why did a rejection happen at that specific level? Okay, so you can kind of tie it all back to the market psychology. So it's the why, not just the what, that's going to give you an edge. We just talked about the body to wick ratio. That's how each individual candle tells its own story. That's cool, but what happens when you see a whole lineup of candlesticks? One trick that literally changed everything for me is blending them together into one big scene. Candlesticks can be complicated, especially if you're new, and that's okay. That's where blending candles can help. Okay, and right here, I'm gonna do a plug because we actually talked about the blending candles. This is one of my favorite candles, this is one of my favorite cards from the Candlestick review cards. So please make sure to scroll down below, check out this deck, just flashcards of all of these amazing patterns. This card is actually one of my favorites because this highlights and it just kind of gives you a quick review on how to do the blending. Okay, but we're about to talk about that right now. now. I just had to do a little quick plug, but So instead of trying to understand every pattern by itself, you can break these groups of candlesticks into concepts, or even just imagine them like a single bar in a higher time frame. For example, you have a lot of candlesticks with long wicks and small bodies. All of that together may represent one constant hesitation or rejection candle on a larger time frame. Blending candles works by compressing several smaller candles into a single larger one. So kind of switching from zoomed in, chaos, to zoomed out, clarity. When you blend candles, you're basically imagining what a higher time frame candle would look like based on the smaller movement. I hope that doesn't sound too fancy, because honestly, it's really easy. Here's the formula. The first thing you're gonna do is take the open price of the first candle in the series. Simple. So you're starting at the beginning of the story. Next, you're gonna get the closing price of the last candle in the series. So this is where the narrative ends. Find the highest price across all the candles that you're blending. That's gonna be your high. So this tells you the ultimate stretch of the price action around this time. And then you're gonna do the same thing with the lowest price in all of these candles. That's gonna give you the floor, the absolute bottom. Now, as far as the color goes, this is where we get that vibe check. Okay, so if the candle closes higher than it opened, then it's green, bullish. If it closes lower, then it's red, bearish. And it's that straightforward. But let's just add a little bit of flair, because theory is one thing, but seeing it in action, that's what makes it click. Okay, so let's take these three candles. So we have one opening at 100, closes at 110. It has a high of 115, a low of 95. Candle 2 opens at 110, closed at 120, has a high of 122 and a low of 105. Candle 3 opens at 120, closes at 114, has a high of 125 and a low of 112. Follow that formula that we just did above. We have our open price, which is going to be 100 from the first candle. Our close price is going to be 114 from candle 3. The high is going to be 125. That's the highest point from all three candles. And the low is going to be 95. That's the lowest point from all three candles. Now the color. Since the close, which was 114, is higher than the open, 100, that blended candle is going to be green. So what do you get? You get one powerful candle with an open of 100, a close of 114, a high at 125, and a low at 95. So that's your story boiled down to its essence. Now this is going to be the next thing, supply and demand zones. If I could go back and redo my early trading journey, supply and demand zones would hands down be in my top lessons. Don't get me wrong. We're talking about support and resistance levels. I promise you they still have their place, but supply and demand zones, that's literally where the action is. When you're looking at supply and demand zones, that's where you stop feeling like you're guessing and start seeing how the big players operate. What are supply and demand zones? So the supply zone, this is where sellers are dominant. These are price zones where big players, meaning institutions, hedge funds, whoever, okay, they have historically placed huge sell orders in these zones. And so that makes the price drop. Higher supply means more stuff, which means the price is going to drop if we want to get rid of this mess. Now, a demand zone on the opposite, that's where buyers were stepping in. So again, we're talking about the big fish here. Demand zones, these are zones where large orders have been placed that push the market higher. More demand means the price increases. More people want in. So you may be thinking, wait, aren't these just support and resistance levels? And honestly, I thought the same thing. Supply and demand, support and resistance, what's the difference? Here's the difference. Supply and demand zones are broader areas. So they're almost like regions on your chart where price action tends to shift direction. Support and resistance levels, on the other hand, they're like specific price points. So this is going to show you where the market has previously reacted in a noticeable way. So maybe it bounced off of this certain price point a few times. So think about support and resistance as more static than a zone. It's more standstill. The price is continuing to reach this level. It's a price. So support and resistance, they're definitely valuable, but they don't really move. Supply and demand, on the other hand, these are zones like neighborhoods where the price is likely to take action. So supply and demand gives you a wider lens to work with. Okay, and so now you would be saying, okay, well, how do I find these supply and demand zones? How do I find the support and resistance? I'm gonna tell you the fastest way that I do it. I don't mark up any charts. I don't do any of that, honey. I let the system do it for me. It's perfect. So I go to TradingView. If you haven't been using TradingView, oh, child, it is the holy grail of charting tools. Okay, so now there's this one indicator that I've been getting into. It's gonna save you all the guesswork, okay? So just type in OB Finder / major OB / supply and demand by TFlab. Okay, and quick note, while this first indicator has order blocks in its name, I'm using this specifically to identify supply and demand zones. And a lot of times these terms can be used interchangeably, but they can mark different areas on your charts. And you're gonna see this when we compare a different indicator later on. Actually, you can probably just type in supply and demand and just look for TFlab. But anyways, now this indicator highlights the supply and demand zones for you. So you don't have to worry about second guessing yourself and all of that. Just focus on the setups, okay? Seriously, this is a game changer. What does this all mean for you? It means knowing these differences is really gonna help you pinpoint good trading opportunities. Now, these blocks are gonna give you an insight into who's calling the shots where in the market. One thing I really like about that indicator that we were talking about from TFlab, not only does that highlight supply and demand zones, but you'll have to go into the settings and click the setting that says to show the most recent support and resistance zone. You don't have to worry about using all these different indicators. You can just keep this all in one. It's going to show you the supply and demand, and it's going to show you support and resistance. So definitely get into that. Shouts out to TFlab for making this awesome indicator. I use it every day. Okay, let's move on. Now I want to talk about indicators. When I started trading, indicators felt like secret weapons. I thought if I just found that one indicator, I would unlock the cheat code to the market. I would be a millionaire, multi. Now, I know for a lot of people, indicators can feel overwhelming. There's so many different ones that you can choose from. And if no one's ever broken it down for you, it's easy to think that they all do similar things. But here's the deal. For the most part, indicators fall into a few categories, and each one is going to have its own superpower. So here's the game plan. Start simple. Start with the 4 main categories of trading indicators. You have trend indicators. These are going to help you figure out where the market is going. Is it bullish or is it bearish? Then you have momentum indicators. These are going to tell you how strong the moves are. You have volume indicators. These give you the behind the scenes context into the price movement. How strong is it? Then you have volatility indicators. The volatility indicators, they're going to show you how wild the price swings are. Here's the thing. If you're curious about diving deeper into each one of these 4 categories, we have a full-blown deep dive video into the best indicators from each of these 4 categories, okay? And then we're gonna break them down so that you can choose the one that fit your style. Now, the golden rule, and this may not be for everybody, but I say use 1 indicator per category. Here's a challenge. Pick 1 indicator from each one of these 4 categories. That's it. So that means on your chart, whatever time frame you're looking at, you're going to have max 4 indicators. I promise you, gonna change your life, okay? Why? Because when you have 15 indicators on your chart, you'll start to notice that one is gonna say the same thing with something else. Whatever bias that you already have, it's gonna give you that. But with 4 indicators in completely different categories, then you're forced to actually read what the market is telling you, okay? Now, if I was gonna start today, just here's a beginner-friendly lineup from an indicator for each of these categories. So for the trend indicators, I would stick with the moving averages. They're simple and timeless. Or if you don't want to use the moving averages, use the super trend indicator. It's very easy, straight to the point. If it crosses above, bullish trend, crosses below, bearish. Easy. So it's like having a second pair of eyes on the market. For the momentum indicators, this is going to show you whether or not things are too hot or too cold. So think about it like the market's thermostat. For these overbought and oversold conditions, I would use the RSI indicator. It's great, very straightforward. Overbought 70, oversold 30. Simple. Now, as far as volume, obviously I would say the volume bars at the bottom of your charts that shows, you know, the price, the volume for each one of these price data points. The traditional volume bars are great, but I would recommend the volume profile indicator because this is going to be your go-to for understanding the price levels that actually matter the most. So it's going to show you where the real action happened, kind of like seeing where everybody parked at a concert. Speaking of that Chris Brown concert, whoo, breezy ball. Anyways, but yeah, and if you're wanting to know more about the volume profile indicator, I have an amazing video that breaks that down as well. So make sure you check out the video we did on the volume profile indicator. And lastly, for volatility, I would say get into the Bollinger Bands. It's very simple, visual, and it's really easy to kind of help you see those breakouts or reversal zones. When you see the Bollinger Bands start to squeeze, that means that a big move is about to happen. Just think about a coil. Boing. Okay, this is going to be the sweet spot. Time frames. What time frame are you using when you're doing these trades? Oh my gosh. If I could go back in time, understanding the chart time frames would be one of the first things that I drilled into my brain. So when I was starting out, I really didn't understand the different time frames and that they each served a different purpose. And figuring this out was a complete game changer for my tradings. This is the most important thing that I've learned about time frames. Every time frame gives you a different perspective, and using them together strategically is going to be one of the easiest ways to level up your trading. Whether or not you're day trading, swing trading, scalp trading, it does not matter. So for day trading or scalp trading, use smaller time frames like the 1 minute chart, 2 minute, 3 minute, 5 minute, and max 15. That's going to show you those quick momentum-based moves. Now for swing traders that are looking at the bigger picture, you want to stick with 4 hour, 1 hour, daily charts. That's your sweet spot. And if you're doing anything longer than that, then I would say daily chart, weekly chart, monthly chart. That's going to show you those bigger trends without the noise. This is where the magic happens. You don't want to just randomly jump around between different time frames. Instead, use them together strategically like a team. This is the structure that I wish somebody taught me earlier. You want to start with the largest time frame. And so this is where you're going to see your trend. So whether or not the market is bullish or bearish, or if it's consolidating, you'll be able to use that larger trend to find it. The next thing you're going to do is move to a middle time frame, something that's a little bit closer than the longer one. So if the longer one was a daily chart, move into a 4 hour chart. And this is where you're going to find those overbought and oversold zones. And you can also put your stop loss levels here. And so this middle view, that's going to give you a layer of nuance before you get into the nitty gritty. And then lastly, you're going to analyze the closest time frame. So this might be an hour chart, maybe a 30-minute or a 15-minute chart. And this is where you're going to pinpoint your entries. And honestly, once I start to use these different time frames, if I'm trading in a trend, the best time to get in a trend is what? A pullback. That's where that overbought, oversold comes in that middle time frame. I promise you, it all lines up. And if I'm looking at a potential trade and each one of these things don't line up, I'm not going to take the trade until they do. Now, if you want a deep dive into the multi-time frame analysis, please make sure you check out this video. It's a little bit older, but I promise you it breaks down this concept so well. You can see the entire market clearly like a picture. So definitely check that video out if you want a step-by-step guide to mastering these analysis techniques. At the end of the day, focus on the process. So choose your style, stick with the time frames that match your goals, and stay consistent. The last thing I want to talk about is price action and volume analysis. So actually seeing these candlestick charts on your time frame and matching it with the volume. Volume is going to tell you how much weight is being applied behind those price moves. Oh, okay. And I almost forgot to add this visual, but I think this is really going to be helpful. When you see the prices going up and the volume is also rising, then that means that buyers are aggressive. Okay. And so the uptrend is strong, and that's where you want to look for potential bullish trades or opportunities. But if the price is going up and the volume is dropping, then that means that that bullish move is starting to get weak. Okay. So there's less traders involved. And even though the price is going up, this is a place to be cautious. This is where I would start to look for signs of a pullback or a reversal. Now, on the flip side, if the price is dropping and the volume is going up, then sellers are in control. Okay, so this is a strong downtrend, and this is where I would think about taking bearish positions. But if the price is falling and the volume is also dropping, then that means that selling pressure is starting to die off. So the downtrend is weak and it could reverse. So instead of chasing the move down, wait for confirmation before taking any trades. Volume either confirms the move or it warns you when it's not real. That volume has to match the price action. So for example, let's say if you see the prices breaking out of a key level, but that volume is weak, don't trust it, because it's probably gonna fizzle out. Now on the opposite, if you see that the price and volume are both moving together, oh baby, you are onto something, okay? That's it. That's momentum that you can ride with confidence. But wait, it gets even better when you add something called order blocks into the mix. And trust me, this was another game changer for me. So order blocks are gonna be areas where institutions, remember what we said, where the big money players have placed their trades. So finding these blocks and zones is like, honestly, it's like a hidden treasure, I promise you, because these are going to be the places where the most critical price changes happen. And especially if you're trading options, that's what we need. So here's how I connect all of those dots between the price action, the volume, and the order blocks. So you can use the price action to find the trend or consolidation zones or those ranging zones. Use your order block to understand where the institutional money is likely jumping in or jumping out. And here's another thing. There's a free flux chart order block indicator on TradingView. Lifesaver. Shouts out to flux charts. They're amazing. But yeah, the flux chart indicator, it shows you exactly where that serious action is happening. So you're not just guessing. Check the volume to validate what's happening. If the price is kind of starting to get weak around an order block, and then you start to see that volume spike, more than likely institutions are the ones that are making those moves in those areas. So honestly, you have a front row seat to some coins, honey. And it's like having your own trading cheat code. Price action gives you direction. Order blocks show you the key zones, and volume shows you if those moves are legit or if it's just noise. So this little combination has completely transformed the way that I trade. I might trade less, but when I do trade, I feel confident about it. Does that make sense? So it kind of simplifies things without losing the depth. Keep these three elements working together and you're going to have a profitable framework to confidently move around, the market. But here is the ultimate thing. Less is more. Less is more. I truly mean it. Less is more. Keep your charts clean, just like your Okay, so trading isn't just about seeing how many indicators you can stack on your chart. It's about being confident. Trust yourself. Start with the basics, master them, and then just build from there. So, all right, fam, let's bring it home. If there's one thing I wish I knew when I started trading, keep it simple. Stay focused. Don't try to get into every strategy. Pick one, okay? Pick one strategy to trade a month or until you're making what you want to make. If it's $2,500 a month and you're only doing breakout trades, go for it. So like I said, pick 1 to 2 strategies that resonate with you, master those. Even here, I have a list of a few strategies that you can pick from. Okay, so pick from this list. I'm gonna have it right here. Look, hold on. Try it out for 30 days, build your foundations with the basics, and then just start to build from there. I want to keep the conversation going. So in the comments below, let me know what's the one thing you wish you knew earlier about technical analysis that you would teach yourself. And if you like the video, please make sure you click that thumbs up button for me. It really helps the channel. Also subscribe and click that notification bell so that you get notified anytime I upload a new video for you guys. All right, and I'll catch you guys in the next one.